Our moderator and discussant for this panel, that's much better. Moderator and discussant for this panel is David Wittenberg of the Mathematica Policy Research. David?
Hello, everybody. I am delighted to introduce Mark Meyer, who's going to talk to us about expanding private disability insurance coverage to help the Ssdi program. And I'm going to have him get right to it, and I've charged him with saying something that brings all those people from there into here. So it's going to be really exciting. Mark?
Talk about pressure. Okay. First of all, I want to thank you. My colleague and co-author, Professor David Babel from Wharton, and I are happy to present to you a proposal, a modest proposal, on a very, very big project, very, very big problem for your consideration. Up to this point, we've been focusing exclusively on Ssdi. We're now going to make a dramatic change, and we're only going to focus primarily on Ssdi. We're going to be taking a look at some other programs and interactions with Ssdi. My area is private disability insurance. Private disability insurance is obviously very helpful to employees and employers. What my little group has been working on over the past few years, however, is thinking about how it can offer benefits to governments. And we have found that it does offer benefits for quite a few people and for a lot of governments in a number of different ways. It keeps people off of Social Security disability insurance, and it removes people from Social Security disability insurance. The problem with this is that only about 1/3 of the private employees are covered by private disability insurance. So the question arises, what happens if you can expand the reach of private disability insurance? Our proposition is that if you expand the reach of private disability insurance, you can actually, as a byproduct, help reduce the Ssdi rolls. So our proposal is a proposal for expanding private disability insurance by having it being offered as an automatic enrollment, much as you now have automatic enrollment in 401ks. The same thing for private disability insurance. It's not a mandate, but if you're offering private disability insurance, if an employer is offering it, the employee has to actually actively check off and say, no, I don't want it. Now, what I'm going to talk about here today is just how we size this. That's going to be my main focus. I want to take advantage of the private disability insurance characteristics and try to explain why we think that there are a significant number of people that currently benefit from it and that can benefit from it in the future if our program is adopted. First thing I'm going to do is take a very, very quick look at the comparison between Ssdi and private group disability coverage. We've talked about this. With Ssdi, you have a wait period. With group disability, you also have a wait period, but that's often integrated with a short-term disability program. The percent of pre-disability income replaced, you all know it starts, at 48%, and then it drops from the next income and drops. Basically what happens is, as you look at it, about 35% of pre-disability income is replaced, maybe less in some cases, maybe a little more in some others. For private disability insurance, it varies a lot, but it's typically about 60%. So if you're making about the average wage, you're going to get about $30,000 a year, which is about $10,000 to $15,000 a year more than you're likely to get on Ssdi. Work incentives, return to work, we've talked a little bit about those. I'm just going to say right now, comprehensive disability management program. We'll talk a little bit more about that later. Employees covered, of course, many more employees covered under Ssdi. Again, only about 1/3 of the employees are covered under private disability insurance. Beneficiaries, the Ssdi program is much bigger. There's about 870,000 current beneficiaries on private group disability insurance. And the premiums, between the employer and the employee, you pay 1.8% up to the maximum, right? And it's going broke. With private disability insurance, it varies a lot, but it runs from $250 to $400 per year. I actually looked at ours just before we came in here, and on $100,000, you pay $18.75 a month or $225 a year for our program at our company. What is the magnitude of early intervention? We've heard a lot about this today, and I'm going to pull out a handful of charts from several studies that talk about the effect of early intervention. Now, this one is particularly interesting. This one is a paper, by Autor, Maestas, Mullen, and Strand. I always have to check which Autor paper it is, right? And this paper is very interesting because the title of it is, Does Delay Cause Decay? All they looked at was how long it takes to get an SSDI decision. Again, this is not private disability right now, but just an SSDI decision, what happens there? And as you can see, there's a downward sloping line here. Along the horizontal axis is months from the application to decision for SSDI benefits, and along the vertical line is the percent of applications with earnings greater than the substantial gainful activity. If you're initially denied, you can see that, the top set of lines. If you're initially approved, you can see that there's a much lower probability of exceeding the SGA. But the important point is there's a downward line, and this has nothing to do other than how fast you get the benefits. No return to work, nothing else. Another study, Schimmel and Stapleton. I wonder where I've heard that name before. Employment by participation in the Ticket to Work programs. This is just one piece of a chart that they had in their paper. And as you can see, non-participants down at the bottom, it's better than the 0.5% that has been mentioned before. But in the Ticket to Work program, you can see it's much, much higher. So there is an effect here of a return to work program. What's the problem with this study? It's a very good study. But what the problem with this study is that there's a lot of self-selection bias in this, right? So guess what happened? Just recently, O'Neill, Mammon, Podamides, I need to have my glasses on, Chan, and De Silva Cordazo came up with a paper. And they take a look at the state vocational rehabilitation authority agencies, enrollees. And the vertical line here, that's the time over the cohort that they're looking at when the state vocational rehabilitation agencies get involved in this cohort. And you can see the top line there. That's the line of the people that were helped by return to work. The bottom lines, there are two of them. One is the overall non-helped, and the other one is a statistically matched cohort. You can see that in most of these cases, it's double the rate of returning to work once you get the state vocational rehabilitation authority agencies involved. And this is a last one that you may not have run across before. This is actually from the tables that the Society of Actuaries put together for private disability insurance. And Group 1, Group 2, 3, and 4, those are different groupings of private disability insurers. And if you see the 100% there, that is what they thought they would get based on the information that they had from the 80s into the 90s. The lines that are there, that's 100%, the lines that are there is what they actually experienced when they started taking the 90s into the mid-2000s. And you can see that some PDI, private disability insurers, are doing much better. And if you take a look, there's another chart that shows that there's a really strong influence that did come about after a certain point in time. So how do we try and size the benefit of PDI to the SSDI? One way that I kind of like to take a look at is by recovery status and SSDI status. Recovery status, you're either working or you're not working. SSDI status, you're either eligible or you're not eligible. You'll see the upper left hand there, it's receiving SSDI. That's not what I'm talking about, but that's been most of the talk about today. I'm talking about the other three. So if you're SSDI and you're not eligible and you're not working, well, that does happen. We have hundreds of thousands of people on private disability insurance that receive it and are not eligible for SSDI. They've avoided SSDI status. Now, not all of them, some of it would be natural. Not all of it is due to return to work programs, and we'll talk about that in a minute. And then you have the working. If you have SSDI and they were eligible, You have exited, you have a situation where they exited or reduced their time on SSDI status. If they never became eligible for SSDI status, again, they avoided SSDI status. My colleagues and I, we did some work. It's very long and involved, but what we're looking at here is at least 65,000 people today would be on SSDI if they hadn't had private disability insurance at the time that they experienced a disability episode. These are people that either avoided SSDI and you never saw them. They may never have even applied for it. Maybe they applied for it and never got it. They are also people here who were on it for a while and then came out of it. So that's what we're talking about here. What happens if we can expand this? Again, only a third of private disability insurers, of employees are covered by private disability insurance. Bartos, Barak, and Shalom. There's another name that's familiar.
Mark, you have to wrap up.
Okay. I'm sorry. So let me just go to the growth in the 401k plans. You can see that we're doing this as the example. And then you can also see this here. So current levels of disability coverage, about a third. It yields at least $900 million a year in savings. Each 10% point, we figure, will add $280 to $350 million years. If you could get opt-out to 50 to 55%, you could save $500 million to $700 million a year. Group disability coverage also generates other federal savings, and the opt-out benefits, come with minimal cost to the government. And opt-out benefits are independent of and in addition to other SSDI-specific proposals. Thank you. Sorry for taking so much time.
All right, we will have the second Mark on the panel. Mark Perriello is going to come talk to us about ensuring access to long-term services and supports for people with disabilities and chronic conditions. Mark.
Thank you. Thanks. Thank you, everyone. It's always fun going after lunch when, it's a little bit sort of nap time in the room, but I will try and keep it as entertaining as possible in my 10 minutes that I have here. First and foremost, I want to thank everyone who helped with the creation of this paper. From the ideas that are contained in it to the drafting of the paper, there really was quite a few people who played a role. I won't list them all, but you know who you are, whether you're in this room or you're participating via the webcast. I'm really, really appreciative because this paper really represents more than just me. I also want to thank the people who selected the paper. I consider myself a self-advocate for people with disabilities, and I think it's really important to have the self-advocacy perspective represented here today, and so thank you for that. Just last week, we celebrated the 25th anniversary of the Americans with Disabilities Act. And that piece of legislation, that law, really transformed the world for people with disabilities and really sort of encouraged and enabled people with disabilities to live independently in their communities. But 25 years later, there is still a fundamental challenge that remains unaddressed, and that is the employment of people with disabilities. Right now, 20% of people with disabilities age 16 and older participate in the labor force. Just 20%. And I would argue that if you want to solve any challenges around SSDI, you need to solve this unemployment problem for people with disabilities as well. And so, another statistic, 1 in 3 people with disabilities lives below the poverty level here in the United States of America. And again, if we are going to solve some of these challenges, I think we need to look at the unemployment rate, at the poverty rates, and figure out solutions for those, and that will have an impact on SSDI and the SSDI roles if we solve some of these challenges. And so SSDI, as everyone in this room knows, was created in 1956, and a lot has changed since 1956. It was never intended to support workers with disabilities. It was intended as a wage replacement program for people who can no longer work due to their disability. And I would argue that today, in this day and age, with new technologies and new ways of doing business, that more people with disabilities can enter the workforce, want to enter the workforce, and are able to enter the workforce. And so the way the programs were created, they really often force people with disabilities to choose not to work in order to gain access to certain long-term services and supports. In the paper that I submitted, we want to change some things in order to make that not the case anymore. An example of that is a personal care attendant. So a lot of private health insurance companies, most would not pay for a personal care attendant, but someone might need that personal care attendant to do the very simple act of moving from their bed in the morning into their chair in order to go and get to work. But are forced basically to choose not to have a personal care attendant if they want to go to work because they can't then afford that personal care attendant. And so what are we proposing in this paper? First and foremost, we're proposing a national Medicaid buy-in program. Right? Medicaid is generally the only way to access affordable long-term services and supports for people with significant disabilities, but the programs vary by state. Services are often provided via a waiver program, and there are often waiting lists for those waiver programs. And so what we want instead is a standard minimum asset and earning limit across the states. We want to provide coverage to all workers with increasing cost sharing and premiums as income increases. We want to allow enrollees to save for emergencies, large purchases, and retirements. We want a standard set of services and supports that are generous in scope and quantity. We want a mandatory minimum grace period for periods of unemployment up to 1 year. And very importantly, we want reciprocity for assets accumulated in a state with more generous asset limits when an individual moves. So right now, a lot of people with disabilities and chronic conditions are forced to live in certain states, and they might get a job offer in another state, but because of the way the Medicaid buy-in program is set up in that state, they really can't have the freedom that other people enjoy. And so going on, right, we want a strong definition of employment, which has been a challenge in the past. We want a functional assessment for eligibility. And we also think that, additional administration would be minimal, as most states already have. 44 states have MIB programs or 1915 waiver programs. The second thing that we propose in our paper is modification to the tax code. Right now, people with disabilities and chronic conditions can apply for the impairment-related work expense, IRWE, and it doesn't go far enough for people with disabilities. And so we want to expand that, and we also want to make it a credit. Right now it is a deduction, and deductions don't help people with low or moderate incomes the way they help some others. And so moving it to a credit, I think, is a very, very important thing. And then finally, we're proposing the study of a wraparound coverage for private insurance to cover long-term services and supports. This would fill in the gaps in coverage for people with disabilities that exist in private insurance, such as durable medical equipment, assistive devices, prescription drug coverage, and personal assistant needs. Individuals would pay a premium to purchase this wraparound coverage, and co-pays for services could apply. There would be no asset limit for participation, and services and supports would be available based on functional need and functional assessment. So one of the challenges with the paper, and I will admit it at the outfront, is that there are no in-depth analysis of a national Medicaid buy-in program at this time, right? And the impact of a tax credit is difficult to estimate, but I believe that in this country, right, if we are going to solve some of these big, big challenges, we really have to look at a new way to help people with disabilities move from where they are and into the workforce. And we need programs and supports that will help get them there. We won't necessarily have all the answers right at the outfront, but I'm hoping that you will take the time look at the paper, look at the ideas contained in there, and take it to the next level. Earlier we were talking about maybe we need to do some pilot programs for some of the ideas that were presented. I actually think that we're a step or two before a pilot program. We need to do some additional studies and get some answers to some tough questions around the ideas in this paper, and then move forward to a pilot phase, and ultimately get more Americans with disabilities into the workforce, contributing to society, paying taxes. As some people say, right, it's the only group of Americans who wants to pay taxes and currently doesn't. Times have changed since SSDI was created, and let's change the programs with the times as well. Thank you.
Okay, for our third paper, John Burton's going to come talk to us about improving the interaction between SSDI and the workers' compensation programs. John?
Thank you. I want to begin by thanking the staff of SSDI Solutions for comments that they've given us on earlier drafts of the paper. I might note we've gone through 2 drafts already. Our final draft is due on September 1. If any of you would like to see the full paper, because obviously I'm only going to touch on parts of this, let me know or let the staff know. We'll get you a copy because we really would like feedback. And I'm sure the other authors would say the same thing. I also want to acknowledge the fact that there's about a dozen or so workers' comp persons in the audience. I'd like to think of them as groupies, but I think they see themselves more in the role of the truth squad, following around the speaker to make sure I don't go too far off target. All right, now let's go to workers' compensation and SSDI. Most of you, I think, know a whole lot about SSDI more than I do. My expertise is workers' compensation. So let me just give a quick overview of some of the differences between the 2 programs. As you know, SSDI is a federal program. It covers all sources of disability, not just work-related. Its benefits are primarily what would be called permanent total disability in the workers' comp jargon. And if you qualify for SSDI benefits, after 29 months, you are entitled to Medicare benefits. Workers' compensation is a state-run program with very rare exceptions. There's no federal standards at all in the program. It does have a work-related test. It provides temporary benefits, temporary total, temporary partial benefits, as well as permanent total. And the major category of benefits in workers' comp is permanent partial benefits. Accounts for about 70% of all benefit payments. So it's a much different mix of benefit types that are in the 2 programs. Workers' comp also provides medical care from the first day of injury. There is an overlap between the 2 programs, which we'll talk about in more detail. There are some data that's put out by the Social Security Administration, says about 12% of all current SSDI cases are either currently in a situation where there's a possible coordination of benefits, which I'll talk about more in a moment, or where there was previously some benefits paid that were subject to the offset. So it's a non-trivial overlap from the standpoint of SSDI benefits. Now, here's some data on what's been happening to workers' compensation and SSDI in terms of benefit payments. You can see that thank you for my assistance here. You can see that beginning about in the early 90s, the 2 programs diverged. Benefit payments went up considerably in the SSDI program. They've been going down steadily in workers' compensation. One of the issues is there some relationship between these 2 trends? And I'm going to talk about 2 possible ways that costs could be shifted from one program to the other. One of them is reflected in this chart. This is a chart that is based on data from the National Council on Compensation Insurance, the rating organization for private carriers in about 45 states, and it shows the 5-year averages or total increases or decreases in benefits resulting from changes in workers' compensation statutes. And what you can see, if you got good eyes, is that up until the early 90s, the numbers were all positive. Since the 90s, the total accumulation is that the workers' compensation statutory changes have been negative. Both decades, the 90s and the early 2000s, that's definitely true. Now, is there a relationship between these changes in state workers' compensation statutes and what's been happening to the SSDI program? There's very little research on that. One of the studies says there isn't a relationship, and I cite that in the paper. A paper that Steve Gow and I did, it was in the Social Security Bulletin, said that between the 80s and 90s, the changes in SSDI applications, about 3 to 4% of the increase in SSDI applications were due to these changes in state workers' compensation laws. We are in the process of updating these data through 2012. They're preliminary at this stage. Our preliminary results suggest that over this period from 1981 to 2012, not only did these state changes in state laws increase applications, they also increased awards in the SSDI program. So that's an area that is to a large extent still open, but certainly suggestive that what's been going on in changes in state laws since the 1990s have had an impact, a partial explanation of why DI benefits have been going up. Now, there's another direct relationship that I want to talk about. Since 1965, the federal law has provided that the total of workers' compensation and DI benefits cannot exceed 80% of wages prior to disability. In 35 states, the reduction is taken in SSDI benefits on the assumption that workers' compensation is the primary supporter of work-related disability. But in 15 states, it's the workers' comp benefits that get reduced. So our proposal here is get rid of the 15 states having the right to have reverse offsets. There's no logical reason why these 15 states should be treated differently than the other 35. Having dealt with that subject in depth, let me move to the next one. There is another current relationship between workers' compensation and federal programs that you may not be aware of. The workers' compensation cases involving permanent partial disability or permanent total disability are typically resolved with settlements, where there's a lump sum payment and the employer or carrier has no longer any responsibility for payments in that case. Compromise release agreements, or as they're known in Florida, my favorite term, they're called washouts. Now, what happens in these settlements? Well, it has been a concern to the federal government because of whether Medicare is being protected in terms of future Medicare payments. And so there is a law now that's being administered that says before a settlement can be made above a certain size in workers' compensation, it has to be approved by CMS. Now, that clearly, to my standpoint, moves the bias towards protecting Medicare and reduces the benefits that are left to pay cash benefits, which indirectly then affects workers' compensation, workers' comp and SSDI. So the proposal here is that there ought to be some comparable, if you're going to intervene on one side of the federal programs, the medical side, you ought to be doing on the cash benefit side. Otherwise, you're just aggravating the problem for the DI program. Proposal number 4. Well, how to avoid needle impairments and work disability. Now, how did that get in there? That's not. Okay. Somebody's. I hit some button here. I bet Doug Holmes did this. It was remote control, right, Doug? Okay, yeah, okay. The proposal number 4 is an idea that's been around for a long time, certainly since the 1970s. Why don't we have federal standards for these state workers' comp programs so that the benefits are higher and therefore there's less to shift into the SSDI program? For reasons explained in this thing, I don't think that's a solution at all, and I reject that. Okay. Now, the final proposal is one that is.
Sorry, we're just getting back to your place.
Okay. Yeah. Well, let me kind of give the lead into this thing. The proposal is to experience rate the employer's premiums in the SSDI program. SSDI is unusual, if not unique, in that it does not experience rate premiums. Premiums are experience rated in unemployment insurance, they're experience rated in workers' compensation, they're experience rated in TDI, and so on. Now, there's quite a bit of difference, and we go into some detail about the difference between the UI and workers' comp experience rating approaches, and come firmly down on the side of saying workers' comp is doing it right. Okay. The question is, what about the SSDI program? And the proposal is, let's modify the workers' comp experience rating proposal and introduce it into the SSDI program. Now, to be very clear on this, we're not talking about just experience rating SSDI work-related injuries or diseases. We're talking about experience rating everything in the SSDI program. Now, why would you do that? Well, the experience in workers' compensation is mixed. You'll see this in the paper, the full paper, but essentially most people who have looked at this subject, and I think probably the people in this audience who are workers' comp aficionados would endorse experience rating. It provides incentives to employers to reduce injuries and diseases. There's an incentive for prevention. Okay. Secondly, it provides incentives to employers to rehabilitate and reemploy workers who are disabled. And in the workers' comp context, this means if you're injured on day one, it's very likely within the week at the outside, you're going to have a medical a nurse there or somebody's on top of this case because the employer doesn't want to pay the higher premium for those disabilities. So there's strong incentives to get into those cases early. And also, there's strong incentives to bring people back to work, because if you bring them back to work, you pay less benefits, and therefore your premium is going to be reduced. Now, there's obviously some limitations on this. One of the concerns is about what happens in the incentives in terms of if you're hiring people who may be prone to disability. Well, this is an issue that workers' compensation has wrestled with since at least for the last 50 years. And there are various approaches that have been tried. For example, there are what are called second injury funds. If you hire somebody who's had a previous injury and they have a second injury, the fund picks up a substantial portion of the benefits for that worker. Another thing that is talked about in our paper is if you want to give incentives to hire older workers, you can have a proposal that says if you hire an older worker, any benefits that are paid to that worker don't account against you when we use the experience rating formula, but the wages do count, so that your assessment rate is going to go down to the extent you hire older workers. Now, there's, again, a lot of this has to be worked out, but all I'm saying is I think there's a real justification for using experience rating in the SSDI program. And indirectly, incidentally, one of the indirect effects is that it will reduce the incentives for employers to shift costs from workers' comp into the SSDI program. My time is up. Thank you very much. I told her before to get up in the chair and wave that when I hit the time limit. She was kind enough not to do that, but thank you all. And I'm looking forward to comments on this.
Okay. Can everybody hear me? Great. The three papers today share a commonality in raising questions of how program interactions influence SSDI. And in thinking about the comments on these papers, I wanted to tie them together with a simple overarching question. That is, if we were to design all of these systems over again from scratch, would it look like this? And I'm here, and so it obviously wouldn't look like this if I thought the answer was no. So the way I'm going to structure my discussion comments is I'm going to review each of the papers in turn. And in each case, actually, I'm going to offer what I'll call a hybrid solution to push the discussion a little bit more based on this sort of overarching principle of would we design the system like this, and then raise questions to each of the panelists. And I'm going to start actually backwards. I'm going to start with John's paper. And John's paper is unique in that it looks at the interaction of 3 programs: workers' compensation, SSDI, and Medicare. The overlap includes workers who experience disability on the job that meets SSDI and workers' compensation eligibility criteria. And as John points out, there's an inconsistency in the policy levers that address these overlaps, which I find very fascinating. The first is the inconsistency in how SSDI benefits are offset in states, with 15 states using a reverse offset that reduces workers' compensation. The second is the Medicare as a second payer, which deals with workers' compensation long-term medical liabilities for Medicare. And this raises a policy difference between how we treat workers' compensation overlaps between SSDI and Medicare in making adjustments. And finally, he looks at work experience rating, noting primarily that the SSDI and workers' compensation systems operate very differently on these incentives. So with these levers in place, I think there are 3 important issues to note that sort of feed into my hybrid option. First, there's a general issue of where does workers' compensation stop and SSDI begin, which has very important implications for who pays for these costs. To illustrate, take a former workers' compensation claimant with a minor injury who winds up on SSDI several years later. Whose responsibility is for payment? Conversely, a very different case could be a blue-collar worker who becomes paralyzed on the job and might be immediately eligible for both programs. A second issue to consider is that employers can rightfully point to the administrative burden of implementing multiple federal policies for SSDI and Medicare. John, I think you call them war shops, so that just gives you some indication of some of the burden. And then finally, with the experience rating idea, that might face a difficult implementation issue of how you insure against a rare event. For a small firm, for example, will they ever experience a change in experience rating under DI, and will it modify their behavior? Still, I'm very compelled by the levers outlined in John's approach and some of the issues above to create what I call this hybrid. One option to address what I consider to be a double insurance problem between SSDI and workers' compensation is to specify the time for when workers' compensation stops and SSDI begins. For example, you could require a workers' comp insurer to provide benefits up to some arbitrary amount of time, say 3 years. If a person qualifies earlier for SSDI, workers' comp is responsible for the SSDI and Medicare payments. For employers, the advantage of this idea is it eliminates the need for existing different provisions for SSDI and Medicare and lessens the long-term liabilities. It also maintains the experience rating advantages of getting employer incentives to immediately serve workers with disabilities following the onset of a disability. And finally, it keeps the incentives away from immediate shifts from workers' comp to SSDI. The limitation of this approach is the proposal could have cost implications depending on how it is designed. For example, the 3 years that I noted could be debated with costs shifting more to workers' comp the longer the period you go out. So my 2 questions for John for the panel, for the discussion section, is for the general issue of how do we think about the overlap between these programs, given it's hard to say when one ends and the other begins? And the second is, are there aspects of your proposal worth combining, such as the offset and the Medicare payer, independently or as an alternative, as I noted above, to ease administrative burdens? The second paper by Mark Meyer takes on the issue of how do we expand coverage for private group long-term disability, which I'll refer to as group disability, given it has potential to slow the entry into SSI. The issues are related to the Burton proposal, given both workers' comp and group disability deal with disability onset. But there are important differences. Namely, workers' comp offers medical and cash supports for those that are injured on the job, whereas private disability provides cash supports. Nonetheless, they share this double insurance problem, and you can argue triple insurance between PDI, workers' compensation, and SSDI. And finally, there's the issue of the information campaign that Mark proposed to get the word out about these options. And here I think there are two issues to really consider. The first is about the overlap between group disability and SSI is really substantial. As noted in the paper by Mark, 72% of long-term group disability cases receive SSDI, and actually there are strong incentives to have these cases apply for SSDI to reduce their burden. And to illustrate some of these incentives, I'm going to take a case example of one of my colleagues who was struck by a car a few years ago from literally this date and went into a coma. Soon thereafter, he was contacted by our group disability provider and then by ALSEP to provide support for an SSDI application. There was intense pressure to apply, which he didn't do because he said, well, I want to go back to work. And he did wind up going back to work. But I use that case because I think there's an important distinction between the types of cases that are out there. He returned to work, but he had the advantages of having a very advanced degree and a spouse. So his options may be very different under these plans than, say, a construction worker. Second is whether firms with disproportionately high risks will be the ones that are most likely to opt out under this plan. And perhaps more importantly, for those who do take up the group disability, will they now change their hiring behavior, particularly for, say, older workers who are more at risk? At least to address the overlap in comment one possibility is, again, specifying where group disability ends and SSDI begins. So this hybrid option is pretty much the same type of hybrid option that I talked about with the Burton proposal. And to illustrate how it might work is this would shift it from a long-term to a short-term plan that would ensure for a certain period, again, say 2 to 3 years. And if people exit PDI prior to that time, the PDI plans would owe costs to SSA. The obvious unknown, just like the other plan, is what the costs. So there are 3 questions that I have for Mark. The first is, how do we sharpen insurer incentives to promote employment for cases where a person might be SSDI eligible, but still interested in working with the right supports? Second, how do we deal with the potential issues with plans altering firm behavior around hiring for those who opt in? And finally, should private industry pay for the information plan? The final paper by Mark Perriello that I'm going to talk about, which is the first paper, is a bit different from the others that I grouped above in that he is looking at medical supports that might slow the transition to DI. And in his paper, he identifies the gaps in long-term support services, which he notes has 2 fundamental problems. First, there are state variations in which plans offer these services. And second, for the Medicaid buy-in programs that do offer these services, you still need to likely qualify to gain these supports. And the key aspects is that he is looking to smooth, I think, and this is in my opinion, the state variation by requiring federal Medicaid buy-in procedures and expanding the tax code to allow for IRWIs. He also proposes a program to provide wraparound coverage. So one of the considerations which he notes for the Medicaid buy-in is that it might not be viable as it shifts burdens to conform to a set of rules. And I also think the costs could be potentially substantial. To illustrate, the Massachusetts Medicaid buy-in procedures for the PASS in 2012 spent $20.8 million on these services. So I think these cost considerations are really, really important. For the tax credit in his second idea, I think implementation for the IRWI tax credit would be less challenging at first glance because the deduction already exists in the tax code. So Mark's policy would essentially expand it as a use of a credit that would be valuable for lower income populations. Still, there's a risk as a credit because you still need a way to document your IRWIs. And if there's a concern of potential overstating your expenses, particularly if it's a refundable credit. And this differs from the EITC where you might have, where you get credits for children and there's a children identifier. And overstating the number of children is hard, though it's not hard for children to understate the number of parents sometimes when I'm with them. So anyway, so my hybrid for you, I'm going to focus most on the tax option, Mark, is that I'm intrigued by the idea of the IRWI tax credit, though I do wonder if it should be capped and non-refundable given the nature of the expenses. And as a second related one, I also wonder if it goes far enough. I know you're focused on IRWIs, but could it be expanded more broadly to a disabled workers tax credit that had been talked about before? And you can imagine documentation through various programs as well as these services. So the questions that I have for you is, given the political issues you noted in the paper, is the Medicaid plan viable, and if so, when? And should, perhaps more fundamentally, should IRWI be the only focus of these tax credits, and how should we specify the implementation? So in summary of this panel, the variations in guidelines governing the different interactions I think is interesting and reflects a need for a more cohesive policy to address a broader issue of system fragmentation. If you believe the basic questions that we could develop a better system, the thing that I would push the audience on is, how do we align these different systems to deal with the fragmentation? And as we align the incentives for those systems, how do we also do this in such a way that it efficiently allocates costs, especially in who, I should say equity affects costs, especially in who pays for the support and the adequacy of those supports. So, I'm done. So we will now do the Q&A portion, and so
Don't we get a minute to respond?
Oh, you do? I'm sorry. I skipped quite over. Thank you very much. You do get a minute. So I apologize. So Mark, why don't we start? Why don't we go from
Okay.
right there?
Good enough. Yeah, the incentive on the PDI to work with people to return to work, I think, is quite high. Sounds to me like your friend who had this situation, fortunately it worked out very well, but the insurer may not exactly know at that time, at any particular time, what the situation looks like, and there would be a benefit to the insurer and a benefit to your friend to have already applied for SSDI. That doesn't mean that, given the situation, that the private insurer wouldn't go ahead and push forward on the return to work itself. I would suggest, if you are taking a look at incentives that stop that, you might want to take a look inside the SSDI program itself, particularly the SGA. That seems to me to be the thing that we were talking about earlier today. That would be the incentive the disincentive, excuse me, that would be more prevalent. Let me go to your third question. Should private industry pay for the information? Yes, they do. But there is something about a federal imprimatur, shall we say, or at least a little bit of information hanging out there from somebody thought to be authoritative, or that's helpful. When you go in and on the first day you're employed, you fill out your health insurance, you fill out your 401k, you finally get to the private disability, right? If you're in the third of the companies that have this, right? By that time, you have nothing, and your human resources people know more about the other stuff, and it just doesn't happen. So yes, they can, they do, they should. It would help to have the federal. And I guess on the second question, I'm having a hard time getting my hands around it. Can you give me an example?
Yeah, I've got to remember my second question again. Sorry. Oh, I'll come back to it.
Okay,
Let's
go
to
ahead.
Mark.
All right. So I think that you raised the right questions. Is the Medicaid buy-in proposal viable, right? And that's the question on the table. And I think ultimately the answer is maybe, right? Here's why. When it comes right down to it, disability issues have really enjoyed strong bipartisan support. If you look just most recently at the anniversary of the ADA, you had Jeb Bush writing an op-ed about unemployment. You have Scott Walker issuing statements from his office as governor of Wisconsin, talking about the things that he is doing to change unemployment rates for people with disabilities. Hillary Clinton chimed in. Bernie Sanders spoke at the National Council of Independent Living conference and for the 25th anniversary. And ultimately, I think that strong bipartisan support could translate into support for a proposal like this. If our leaders are willing to sort of take the next step from rhetoric and go into some actual policy making, and that's the crux of the matter, right? Are they willing to go from that op-ed that scores them some points with people with disabilities and those who care about them and take it to the next level and actually put some policies in place that will change lives for people? Regarding the tax credit, I think you bring up the right question. I think there is the possibility that other avenues could be explored and should be explored.
Okay, thanks. Mark, let me turn back to, before we go to you, Jen. The specific question I had for you is, once a firm opts into the insurance plan, is there a potential discrimination effect given that they now may have less of an incentive to hire a person that will experience the onset of a disability because their premiums could go up?
I don't really see that. I mean, my experience with this, and I'm sure there are others who have other experience, the disability comes on fairly suddenly. Mm-hmm. It's not expected. It most of the time comes on not in the work context. It comes on because of an accident or because of an illness.
But for an older worker, they'd have a higher probability.
Older workers have a higher probability, yes.
Yeah.
I think that also comes into the medical care aspect of things too.
Mm-hmm.
I can see what you're talking about, but I don't see this as a major impediment in that area.
Okay. John?
Okay. Well, you have a question here about, does it make sense to combine offset and Medicare set aside into one place to make decisions? Before today, I would have said yes. What I heard today about interagency rivalry makes me wonder about that as to whether it would work, because you clearly need some cooperation if you're going to have the Social Security Administration and Medicaid or CMS cooperate. I don't know the answer to that one, but at least in principle it makes sense to put them together. You're probably going to need to get a czar. Number two, an aside, you said, this issue, you raised the canard again about small firms being experience rated. Well, the paper talks at length about the fact if you go into the UI program, every firm, no matter how small, is experience rated. In workers' compensation, most employers are not experience rated, other than there's a first level of experience rating that has rates set for different industries. But firm level experience rating, where your own benefit payments affect the rates you pay, is found in less than half of all firms, although most employees work for firms that are experience rated. So there's a lot of background on this issue of what to do about small employers and credibility and so on, and that is briefly discussed in the paper, but I don't think that's a legitimate reason at all for rejecting experience rating in Social Security. Now, the final point you make, question you asked about, how about the overlaps among these programs? When does one stop and when does one begin? I wouldn't touch any individual program. I would leave worker comp exactly as it is, other than these few things on the offset rules and so on. I would leave long-term disability the way it is. I would make a change in Social Security to experience rated. And how do you coordinate all these things? Well, Pat Owens is the answer. There was this time in the early 90s when Pat was vice president of Unum. I was doing some consulting. Stanley Zach, who was president of Zenith Insurance Company and a healthcare provider in California, worked out a single, what was it called, single point? Yep. Single point policy, where an individual company buys the policy and that single administrative instruction takes care of all these things. That's the market solves this problem for you. You don't need a government agency. You don't need to redo the programs. There's plenty of capacity out there among private insurance companies or other third-party administrators to set up a way to coordinate these programs. The only missing piece is that right now we've got incentives to dump things into the Ssdi program because it's not experience rating. Solve that problem, turn it over to Pat, and we got it.
All right. Well, yeah. Well, I think you can have the first question. You have the first.
It didn't work. I want everybody to know the single point issue.
Can you use the microphone, Pat?
For a variety of reasons. Many of them having to do with the various insurance requirements, the regulatory requirements for long-term disability, workers' comp, and healthcare. They were all regulated, the stovepipey type thing, which goes back to there is an overarching governmental issue about how the regulatory environment, how it sets, and how things can work together. So it's not quite as easy as John said.
I simplified it. Let me just add one other thing. Obviously, this is a very complicated subject. If you look at what's happened in disability management among large employers, there's been a revolution in the last 20 years, 25 years, of moving from the group that handled the liability insurance, handled workers' comp, the health insurance people handled health insurance. They had somebody else who was handling this. So these people did not work together. In a lot of corporations now, these are integrating. Okay? We have a comprehensive integrated disability system. So I may have oversimplified this thing, but we have organizations like the Integrated Business Institute. Well, I forgot the name of the organization, but there's a whole army of people out here now who are working on this project. And Pam, I think you caught me up, and I apologize for overselling your
It's okay.
endorsement of this. Let me just add, I think it was another reason why it failed in the 90s, because premiums started coming down so rapidly that it became less attractive. But I think, but I think there's a real potential there for a private sector solution, frankly, to a problem of coordination and without having to redo the programs fundamentally.
Well, another point on that is that I do think that the healthcare system was the main reason why it didn't work, because New York or California was going into managed care, and there were very, very many managed care organizations trying to figure out the right premiums and how to set the premiums and all of that. But I do have a question. Stan Zacks, who was responsible for that, used to have a saying, the pioneers get the arrows and the settlers get the land. So maybe that's a good thing to think about as we're thinking about these changes too. I didn't quite understand. First I wanted to say, Mark P., I think you're calling attention to the perspective that you gave us from the consumer's perspective and what is needed early on. It was very important, and that we need to think more with that in our minds. But the other Mark, I didn't quite understand how that was all going to. I mean, how are you going to require that employers offer this, or is it legislative, or you? What?
No, it's not.
I couldn't get it. I mean, I couldn't.
Yeah. No, it's not a requirement. It's not an imposition. It's a modest proposal, but one that we think could help increase. If you back up to the 401k in 2005, 2006, before they had auto enrollment, participation rates were very much lower than they are in 2013 after they have auto enrollment. It's a matter of clearing the way, clearing the underbrush, the legal regulatory underbrush, the practice, clearing it out and saying, no, as you can with a 401k, you can now do this with long-term group disability. You can have an opt-out program.
Hi, Mark. Thanks for your comments. Quick question. Did I understand you? I got the impression anyway that what you were saying was that people who are under these short-term, long-term private disability plans through companies are not seeking Social Security disability benefits. Did you say that? Oh, I misunderstood that.
No, I didn't say that.
Okay, because it's been my experience that practically all of them are required to seek Social Security.
Yet,
Yeah, to remain eligible to receive benefits, short-term, long-term.
right. No, I did not say that. I'm sorry if that was.
Lisa, and then.
Hi, Lisa Ekman. I want to stick with you, Mr. Meyer, and just 2 points. Just one is that when Congress removed the legal underbrush, as you say, to allow auto-enrollment in 401ks, they also required certain things happen with those 401ks, and only certain 401ks that meet requirements are allowed to have people auto-enroll. So as we think about auto-enrolling people into private disability plans, I think we need to think about what regulation and requirements for those plans need to be put in place as well. And sort of a follow-up to the last question, in looking at your chart where you have the 4 quadrants, and the one quadrant has 50,000 people who are not getting DI and are not working, and I'm just wondering how you arrive at 50,000, because as you say, and as was just pointed out, pretty much every plan requires someone who's going to be on benefits long term to apply for SSDI. So where are these 50,000 people coming from? How do you arrive at that figure?
Right. I would have to refer you to the paper, which contains a better description of this. But basically what happens is you do have, for example, right now, 32% of the 870,000 people on long-term disability that are not receiving SSDI. If you take and apply certain probabilities out of the actuarial studies and the like, you can come up with, on a conservative basis, that there are 50,000 people that, over the period of time, that were not working. Maybe they're working now, but that made their way out of ever being within SSDI. No, no.
They just didn't ever apply. I wonder how you get it. They would ever have been eligible, because it's a different definition in private disability of own occupation versus any occupation. So I'm just, and in the previous version of the paper you did, it basically says we estimate a quarter. That's all it says, and it doesn't provide any background as to where that number comes from. So I'm confused about how you get there.
The way you get there is you see what the return to work effects are within SSDI itself and within the private disability, the Society of Actuarials work, and you see that there are actually very large percentages that come about and that improve. And in the context of this, a quarter is a fairly conservative assumption with regard to this.
So I have 2 questions over on this table and a third one back here. So let's start over here. One over here. Yes.
Pam Villarreal here. I wanted to ask you, Mark, in regards to private disability. I'm a big fan of private disability insurance. I think it offers a better deal all the way around. But my question is, if you have a system where people can opt out, it seems to me that the people who would be most attracted to private disability insurance are going to be higher income, they're going to be healthier, because they'll have a larger income replacement rate. So the people that are going to be left, as in most government programs, you have crowd out. So you're going to have people who are on SSDI who are lower income and probably more likely to become disabled. So how do you deal with crowd out? And another question I have is, how can private disability insurance compete with SSDI when, even though you don't get rich off of SSDI, you become eligible for Medicare in 2 years, you can become a dual eligible if by becoming eligible for Medicaid, you get subsidized housing, and as in the case of a friend of mine, he's been absolved of his student loans. So how can private disability compete with all those other bells and whistles of SSDI? Thank you.
I'll take your second question first, and it doesn't, in my view, compete with SSDI. It complements SSDI. It offers up something for those who are willing to pay up for it, or have employers willing to pay up for it, that goes on top of SSDI, which, by the way, the affected individual has already paid for, as everybody else has already paid for with their Social Security taxes. Going to your first, I guess there's a little bit of confusion here, and I can kind of understand that. Right now, the situation is in a number of different firms, in a number of different places, that you have to affirmatively opt in in order to get private disability insurance. And I would contend that having to affirmatively opt in will lead to more anti-selection, more adverse selection than an opt-out situation where everybody is presumed to go into it, where the group is automatically bigger, rather, so that the people, have to affirmatively opt out. So my mistake if I didn't make that clear.
I think there was a question right at that table. Yep. And then,
I'm one of those work comp wonks that John referred to. John and I have crossed swords many times on this benefit issue, but I see in his paper he declared a truce, and I'm happy to honor that. But I can't resist commenting on two of his recommendations. The first was on experience rating. Experience rating is a wonderful thing in workers' compensation. I'm an ardent fan of experience rating. It's been used for decades. It's a well-refined tool. But I have difficulty applying it to SSDI because of the infrequency of claims for small employers. In most state systems, the vast majority, 70–80% of employers aren't going to have a lost time claim in 3 years. For an event as infrequent as total permanent impairment, that frequency of occurrence would be minuscule for small employers. So I have difficulties, one, from an actuarial perspective in figuring out what that rating system would be like. And second of all, I wonder from a behavioral point of view, how would these very infrequent events enter into the thinking of an employer who may not have a disability in their entire business ownership's existence? And so I guess it's a concern. It's not an impossible idea, but I can see a lot of roadblocks actuarially and behaviorally. The other issue about settlements perplexes me. Most settlements in workers' compensation derive from, regarding lost time, not medical benefits, derive from two things. Was the event compensable in the first place? And second of all, what is the extent of permanent disability? Now, if you're arguing, if the two sides are arguing that it wasn't compensable or was compensable, I don't know where SSDI's interest is in that settlement, because there's no concession that there was a compensable event. And the second thing is on the degree of permanency. Typical argument would be back injury, the employer, insurers declaring 100 weeks as of PPD as the proper compensation. The attorney for the injured worker is saying 200 weeks. That's a typical argument. I'm perplexed as to how you would figure out what SSDI's interest is in this dispute between 100 weeks and 200 weeks.
Well, I guess I can respond to this. I'm a little shocked to hear you bring up this argument about small employers never having incidents in SSDI. They're not going to be experience rated. For the average employer under SSDI, the proposal would be the same thing we do for workers' comp. We don't do experience rating for most, firm level experience rating for most firms in workers' compensation. The same thing would be true of SSDI. Now, are there enough claims around for larger employers? I'm assuming there's enough around or we wouldn't be at this conference. Fact of the matter is, the thing is being driven by the fact that the number of claims from SSDI has gone up very rapidly, and there's a lot of them. And for large firms who have a credible base of previous experience with SSDI benefits, it's got to make a difference. So, the argument, it's the same thing we have in workers' compensation just translates over here. Actuarially, it's the same approach that I'm proposing for SSDI. Most small firms are never going to be touched by experience rating. Okay. Now, on the point of the settlements, obviously we have somewhat different perceptions of what goes on. My perception of settlements, and having looked at a lot of closed case files, you'll typically find in a closed case file a settlement in a case which is $100,000, which covers future medical and future cash payments, with no specific allocation in a lot of those settlements as to how much of it's due for cash benefits and how much medical. You just agree both of those things are taken care of, and there's no further liability for the employer. Let's just say hypothetically, if there was in CMS, that it would have been $20,000 for medical and $80,000 for cash. CMS comes in and says, no, $20,000 isn't enough. We want $40,000. Okay. From a standpoint of the employer, or even, frankly, a lot of lawyers, they don't care whether it's $20,000 or $40,000. They'll make it $40,000. Fine, except that means the amount that's left over for cash benefits is now not $80,000, it's $60,000. And the $60,000 becomes relevant for SSDI program because the benefits that are paid under workers' compensation are subject to this offset rule. The less money that's coming out of workers' compensation, the more that the SSDI program has to pick up in a case where there's the potentially would be over 80%. So that it does make a difference. And all I'm saying is we've got a program right now that protects CMS, make sure that the Medicare program is relatively well taken care of, but at the expense of the cash benefit component of the settlement, which then spills over to a problem for the SSDI program.
This is the last question. It's the person in the back, and I apologize.
Hi, this is Paul Cullinan. This is from Mark Meyer again. Could you give us a little feel for who pays the premiums, the distribution between the employer and employee? And also, is the 30%, 40%, or whatever largely a function of the offer rate or of the participation rate?
Sure. If you take a look at the BLS statistics, it looks to be mostly a function of the offer rate. In other words, whether the employer offers long-term disability. The participation rate is quite high. Talking to the disability insurance providers, however, they're scratching their heads at this a little bit. And some of it relates to the first part of your question, which is who is paying for it. In the case where the employer pays for it, and I don't have really good numbers on that off the top of my head, everybody ends up being covered by long-term disability. There are also cases where where they share part of it. Indeed, under the tax laws and the way this works, even if your employer offers to pay for it, you should probably not accept that offer. You should probably pay for it yourself, because in the situation of the world where you need disability insurance, if the employer pays for it, you pay taxes on your disability. If you pay for it after tax, it's tax-free. So, and then there are the situations where you pay for it yourself. I don't remember those numbers off the top of my head, but you can look up the BLS figures, and we can talk about this a little bit later.
All right. Well, with that, I am going to close out this panel, and thank you, everybody, for an interesting discussion.